Hello, I'm Haider Malik, host of the Memi Financial Group podcast. Today's topic is buying a competitor acquisition loans for Vancouver manufacturers. Acquiring a rival plant or product line can accelerate your market share, expand capabilities, and secure key talent, but you need the right acquisition financing to execute efficiently and preserve your balance sheet. Here's how Vancouver manufacturers can structure and secure acquisition loans. 1. Clarify your acquisition structure. Asset versus share purchase. Asset purchase. You acquire equipment, inventory, customer contracts, limits hidden liabilities. Share purchase. You buy the entire company, including intellectual property, workforce, and existing debt, may require deeper due diligence but preserves continuity. 2. Financing components. 1. Senior acquisition loan. Covers 50-70% of purchase price. Term 5 to 7 years, fixed or floating, prime plus 1%. Underwriting based on pro forma combined cash flows, backlog, and equipment collateral. 2. Mezzanine or second lien debt. Covers 10 to 20% gap between senior debt and equity. Shorter term 3 to 5 years, higher margin, prime plus 3 to 5%, may include PIK interest or warrants. 3. Seller financing. Deferred payments to the seller 5 to 15% of price tied to performance or earnouts. Aligns incentives and reduces upfront cash. 4. Equity contribution. Your cash, partner capital, or private equity co-investment 20 to 30%. Demonstrates skin in the game and lowers leverage. 3. Due diligence essentials. Plant and equipment valuation. Engage a local appraiser to value CNC lines, presses, and automation systems based on Vancouver resale data and utilization rates. Contract and backlog audit. Review existing orders, food processing, fabrications, packaging lines, and confirm margin profiles, renewal likelihood, and customer mix. Workforce and IP review. Assess key staff retention risks, union agreements, patents, trade secrets, and software licenses. 4. Selecting lenders. Local banks and credit unions. Institutions like Vancity, Coast Capital, and large Canadian banks understand BC manufacturing cycles. Specialty acquisition lenders. Non-bank finance houses that handle layered capital stacks, seller notes, and mezzanine structures. Strategic investors. Consider private equity or family office co-investors to bolster equity and strategic expertise. 5. Structuring covenants and protections. Debt service coverage ratio. Model combined EBITDA. Target at least 1.25x coverage on senior debt. Leverage covenant. Negotiate maximum debt to EBITDA ratios with seasonality buffers. Escrow and holdback. Reserve 5 to 10% of purchase price in escrow for warranty claims, lien releases, or post-close adjustments. Interest-only periods. Request a 6-12-month interest-only window to ease cash flow during integration. 6. Execution roadmap. 1. Letter of intent, LOI. Secure exclusivity, outline price, structure, and due diligence scope. 2. Due diligence, 30 to 45 days. Complete plant audits, contract reviews, financial tests. 3. Commitment letter. Obtain lender term sheets committing senior mezzanine and seller note financing. 4. Closing, 60-90 days. Finalize agreements, draw funds, and execute the acquisition. 7. Post-acquisition integration. Operational alignment. Merge ERP, production scheduling, and quality systems to capture synergies. Retention strategies. Offer retention bonuses or rollover equity to key engineers, supervisors, and sales staff. Cost synergies. Combine procurement, maintenance, and distribution to drive 5 to 10% expense savings. 3 action steps. 1. Package your case. Prepare pro forma financials, equipment schedules, and backlog summaries demonstrating combined cash flows and debt service capacity. 2. Engage advisors. Work with a corporate finance advisor and legal counsel experienced in manufacturing malsundé. 3. Solicit competitive bids. Request indicative term sheets from at least 3 lenders, banks, credit unions, and specialty financiers, and use them to negotiate optimal rates, covenants, and structures. With a layered financing approach, senior loans, mezzanine, seller notes, and equity, you'll secure the capital needed to acquire a competitor efficiently, preserve liquidity, and drive growth in Vancouver's manufacturing sector. I'm Haider Malik. Thanks for listening.